Hello friends, welcome to my YouTube channel. In this video I have come up with a new video related to mutual funds. So in this video I will be giving a comparison of two types of investment in mutual fund, that is investment via SIP route and the investment via Lumpsum Route. So SIP route is a route where we actually invest in mutual funds in a systematic manner. We invest a certain amount of money, say 2000 rupees or 5000 rupees every month in mutual funds. Lumpsum route is a one-time investment where we make a single contribution, say 20,000 rupees or 30,000 rupees in the mutual funds. So I will actually explain the advantages of both these options, and which option should be used by us for getting the maximum returns and based on our income, and so that our future needs are actually satisfied. So I request you to watch the video till the end. So I will actually give a comparison of both these types of investment options. So please subscribe to my channel so that I can post new videos related to mutual funds. And so let us go to the video. So in this video I have taken an example of a good performing fund, that is Kotak Equity India Opportunities Fund. So that is an equity fund. The current NAV is around 140 rupees. So the fund was actually started it came with NFO in 2004, and the current NAV is now around 140, means that the fund has given around a total of 1306% returns. So the annualized return for this particular fund till from the inception is 17.7%, and the category average is 13.85. For the 10 years it's given 11.31%, and the 5 years it is given 11.85% annual return. So I will be using this particular fund as a example for explaining the differences between investment in Lumpsum route and SIP route. So I had prepared an Excel spreadsheet where I had actually taken this particular fund, that is Kotak Equity Opportunities Fund. The NAV is 140 rupees. So if you want to reach an NAV, the fund was actually came with an NFO in 2004 at 10 rupees. So if you want, that particular fund needs to have an NAV of 140 rupees. So I did a rough calculation how the growth the fund has actually grown over the years. I found that it has grown at an annual rate of around 18% to reach the NAV of 141. That is from 2005 NAV should have been 11.80 based on 18% growth. The next year it was 13.92, like that it grew to around 141. So based on that, suppose if the particular investor is investing in that particular fund in Lumpsum Route in 2004 during the NFO, suppose if he is investing, he has a surplus of around 2 lakh rupees and investing 2 lakh rupees in NFO at 2000 rupees, he might have gotten units of 20,400 units. So assuming the current NAV 144 rupees, so if he had initially invested in 2004, the total fund value at the current NAV of 141 is 141 into that accumulate initially invested units at 20,400, that comes to around 28.82 lakhs. So the initial investment 2 lakh worth is worth around 28.82 lakhs if he has investment in the Lumpsum route. Let us say take the scenario where an investor is investing by SIP route. Consider the same company that actually grown from around 10 rupees to 140 rupees 141 rupees over a period of 20 years. So he is actually investing, suppose if he is actually investing by SIP route, he will be investing around 1000 rupees per month. So that comes to 12,000 rupees per year. So the total investment will be around 2,50,000 over a period of 2 lakh over a period of 20 years. So the first year its total investment would be, first year is NAV is 10, and 2005 is NAV would be 11.80. Considering the average NAV, you are actually calculating the units for each year, so it will be higher in the first year. When the NAV grows, the total number of units you will be purchasing will be lower. 932 will be units he will be purchasing next year. Like that, if you actually compare for the entire year, you can actually get that he was able to accumulate 6,784 units over a period of 20 years to SIP route. Remember that he's actually investing only just 10,000 rupees per year, as compared to lump sum investment of 2 lakh he is investing at the start itself. So he's just accumulating 6784 units. So the total fund value at the end of 20 years is 141 into 6784, that comes to around 9.85 lakhs. So instead of 27 lakhs, he is actually getting only 9.75 lakhs. He is actually investing in the SIP route. So there are some so this clearly shows that there are some differences in investing in lump sum route. If we have surplus cash, so if we are actually having 5 lakh in our bank deposits and or 1 lakh in a bank deposits, if you're actually planning to invest in fixed deposits, so it is worthwhile to invest in them in lump sum mutual fund in NFO at 10 rupees instead of putting 1,000 rupees in SIP in different companies. So there is a trick that is adapted by mutual fund companies, because they actually want investors to put money every month in the mutual fund units. So they actually are promoting SIP investments also. But we have proved that if there are surplus funds available for investors, it is good to invest in lump sum route also. But if investors actually having only say low salary, say 10,000, 20,000 rupees, is able to save only 5,000 rupees, he can actually invest in SIP route itself, and he can put 1,000 rupees or 2,000 rupees in SIP route, so that itself can actually give good returns in future. But he has surplus cash, able to save some amount, say 1 lakh rupees or a period of 2, 3, 4 months. This the best option would be to invest in a lump sum route. So that depends on the surplus funds available for the particular investor after all his basic expenses, related daily expenses, then after the deduction for his important expenses like home loans, insurance premiums, like that. After all the deductions, and if he's able to save something, he can actually decide whether he can actually want to invest in either SIP route or lump sum route. So regarding the, suppose if we are actually, instead of this Kotak equity opportunities fund, if we are actually investing in a new fund offer of a new company also at 10 rupees, so even if we just imagine 10% to 12% invest growth, say for we are investing a lump sum of 2,50,000 rupees, we are actually accumulating 25,000 units, and the total units, the fund value at the end of 10 years would be 27 lakhs, based on the 12% growth over a period of 20 years. Because for the first year the NAV was 10, it grew to 11.20 in 2021, like that it goes to around, the NAV goes to around 108 in the end of 20 years. So the fund value is 108.04 into 25,000, that comes to around 27 lakhs if you are actually investing via lump sum route. So the same thing, if you are actually investing via SIP routes, we will be investing only 12,000 rupees per year, and for a year, so the first year you will be accumulating for 12,000 rupees per year, we will be accumulating 132 units, and for the next year, based on the average NAV for 2021, we will be accumulating 1,001.78 units, like that. Then based on the increased NAV, the total units will be accumulating will be reducing, and the end of 20 years will be accumulating a total amount of 25,000, total units of 9,588. So the fund value will be 9,588 into 108, that comes to 10.86 lakhs. So that is half of the value that we would have actually got if we are actually investing directly at the lump sum level, initially at the start by investing in NF for 10 rupees. So if we have surplus funds in our disposal, say even not even 2 lakhs, say for 40,000, 50,000, instead of putting 1,000 rupees or 2,000 rupees by SIP route, it makes sense to put in a lump sum in NFO, in a good quality mutual funds at the NFO. Also, even if we consider, suppose if you are actually trying to park an amount, say if you are actually having 5 lakh amount, if you want to park the amount in fixed deposits also. So suppose if the same, instead of putting in SIP, suppose if we actually considering the difference amount, say suppose we are investing only in SIP, we want to park the balance amount in fixed deposits. So the difference of the lump sum investment, suppose we have 2,50,000 rupees and investing only 12,000 in by SIP, and if we are actually putting the balance amount in fixed deposit, we'll be getting only interest of around, considering the interest of 8%, we'll be getting only 19,000 rupees as interest per year. So that comes to 3 lakh over a period of 20 years. So even if we add the interest of that fixed deposit, total comes to just 9,58,000 plus 3 lakh, that is 14 lakhs only. So that is not even, that is just half of the value that will be accumulated if you are actually investing directly in lump sum route. So if we so this particular shows that if we have funds in our disposal, the lump sum investment is advised for investors. But if you don't have any surplus for investment, SIP route is advised to the investors. So actually, I hope everyone should have understood the differences and best option that investor need to take for SIP and regarding the mutual funds, be it SIP or lump sum. Another option that investor can actually opt for is a systematic withdrawal plan. So they can actually opt for a lump sum investment of 1 lakh or 2 lakh. They can actually even opt for a systematic withdrawal of 2000 rupees per month. So they want to have an interest or return every month. So if they have surplus at the end of every month, the 20,000 they can additionally invest so that the total unit they have will not reduce it. Otherwise, if they want some return, they can actually even opt for a systematic withdrawal plan based on the initial lump sum investment of 1 lakh or 2 lakh. So there are different options available: lump sum with SWP, or lump sum directly, or systematic investment plan based on the balance savings available for the investors. So I just want to convey this message. If you like the video, please give a like to this video, and please subscribe to my channel so that I can actually post new informative videos regarding the mutual funds. So please refer to the disclaimer also regarding this, and thank you for watching the presentation again.